one told me about land tax. Land tax is like that unknown tax, the one that sneaks up on you when you don't expect it because no one told you about it.
Vishal Sharma, an authority on land tax with Revenue New South Wales. Welcome to the Australian Property Investment Podcast. How you doing?
Good, thanks. Thanks for having me. You'll buy one property and you might never hear about land tax. And you buy another one and next minute you might have to pay. Bank didn't tell me about land tax. Real estate agent didn't tell me about land tax. Conveyancer didn't tell me about land tax. Property manager didn't tell me about land tax.
And then suddenly the government goes, well, here's an invoice for more tax.
And that's where people get caught out. It's not often talked about.
G'day everyone. If you've been listening for some time, you know that one of my big mantras is paying more tax is a success fee. So do not be scared of paying tax. I'm talking your capital gains tax. You think about income tax. The second that you start to earn more, you pay more tax. The pie just simply gets bigger. So do not fear tax. We live in an amazing country. And Vishal, I know we'll talk about your background in a second because I've got two Brown brothers in the studio. But I say, mate, this is one of the best countries to live. Yes,
Agreed.
We have a high cost of living, but man, we have a high standard of living. And if it means we're paying tax, whether it's a government tax like stamp duty, for example, whether you're paying land tax, capital gains tax, income tax, yes, there are a few taxes. I run a business. I pay a bucket load more taxes as well. But all that means is, and I think I've got a really good accountant who says, mate, if you're making money, you're paying more tax, it's going towards this great country. What are you worried about? So I hope that lays a really good foundation for what we're going to speak about today, because I do bring in the big guns, so what I call best in breed. Vishal Sharma, you're an authority on land tax with Revenue New South Wales.
Yes.
Welcome to the show and the Australian Property Investment Podcast. How you doing?
Good, thanks. Thanks for having me.
Mate, I appreciate it. You know, it's when I asked you before we grabbed a coffee, what's your remit? You're like, this is what I do. I'll jump on a podcast or do I'll do a conference, for example. I guess really unlocking or maybe dispelling a few myths around what land tax is and what the role of, say, Revenue New South Wales is as well. Yeah.
Yeah. It's a few things. I mean, the role that I have at Revenue is getting information out there, not just the industry professionals, but communities and investors and stuff as well. But land tax is like that unknown tax. It's like the one that sneaks up on you when you don't expect it or because no one told you about it.
Yeah.
So a big part of my role is spreading that awareness and knowledge about land tax so that people don't get caught off guard by it. And so that people can like voluntarily comply, right, with the requirements rather than, being picked up through audits and things like that.
Mate, correct. No, I guess nothing hurts more than something unforeseen, like a sting, like a land tax. While I say on one hand it's a success fee, for example, it comes with, accumulating wealth. Other people are like, yeah, but I didn't see it coming. And that's probably what grinds their gears so much. It'd be like me making more money in my business and then suddenly the government goes, well, here's an invoice for more tax. I'm like, geez, mate, I did not see that one coming, and that now burns.
Yep.
Yeah.
I think a big reason for that is, as a property investor or a property owner, whether you're a business or whatever, there is that tax-free threshold.
Yeah.
And you won't start paying land tax until you reach that threshold. Depending on your ownership structure, there are different rules for different entity types.
Yes.
But you might be someone who, typically your mum and dad investor, you'll buy one property and you might never hear about land tax because you haven't quite crossed that threshold where you have to pay it. And you go, oh, this is great. And you buy another one and, next minute you might have to pay. And one of the things that we see a lot through the customer journey when we speak to our land tax customers is they always say, oh, no one told me about land tax. And I think I made a joke about this on another platform recently. I compared land tax to Fight Club because no one talks about it. And it seemed to make sense at the time afterwards. I was like, I probably shouldn't have said that. But anyway.
If you know, you know.
Yeah, if you know, you know. But at the end of the day, it is one of those taxes that you can go through the whole ownership journey or the purchase journey as an investor and have no one tell you about it. And I myself, when I bought my first investment property, and working at Revenue, so knowing about all the different taxes and stuff, I kind of paid attention to what people were saying along the way. And I was like, wow, I got a pre-approval from the bank. No one told me about land tax. Real estate agent didn't tell me about land tax. Conveyancer didn't tell me about land tax. Property manager didn't tell me about land tax. Went to lodge my tax return. My accountant didn't mention land tax. And I was like, no wonder people don't know about it, right? Because no one's actively there often telling you that, hey, land tax is a thing, you need to lodge a return and register because you're liable to pay.
Yeah.
And that's where people get caught out because it's not often talked about. And so the first time people find out about it is when they get a letter from Revenue New South Wales saying, hey, you own this property, or you've amassed a certain value of property, and you're now liable to pay land tax. Please lodge a return.
Mate, spot on. I remember, I mean, anyone listening would know that we've got a commercial property. And that envelope, you're like, I know this looks suspicious, this envelope. There's a bill waiting for me on the inside. You open it up, I was like, holy doodly, it's and then again, I got to remind myself, it's going, man, that comes with owning, that comes with part of the territory. It comes with the turf of owning property, whether it's residential, commercial. And we'll go into all that in a little bit, buddy. But I think you're right. Who owns this space? And that's primarily the driver of what we're doing with this podcast. It's education, it's empowerment, for example. It's bringing people that have the expertise and knowledge that I lack even, and you become a subject matter expert. So I'm sure anyone listening will go, right, I may have interstate properties, but land taxes across the country just differs from state to state. So don't be too hung up if you don't have an investment property in, say, New South Wales. Take the principles and the knowledge and go find the answer out for your particular state policies and what that entails as well. So that gives a good starting point. I mean, you said that you own property, which gives you a lot of empathy towards your customers that pay land tax. I think that's fantastic. But take me through, mate, because again, we're having a chat beforehand about your career in government and what that's looked like. What's been the pathway journey for you to get to this point in your career, buddy?
So it's been, I've worked in the private sector as well. I've bounced around with a few different roles, but there has been a decent. I'd say at this point I'm almost a career public servant. So I had my nice jobs that you have as a young person. Fast food and all that stuff. And
your rites of passage.
That's it. Did a bit of hospitality, and then
awesome.
My first sort of role working in the corporate scene was with AMP.
Yeah.
Many years ago. Don't want to give my age away.
Mm-hmm.
Although I probably will.
From there, your beard's not grey enough, so I'm definitely got some years on you. But anyway,
but we started there. Went to my first government role, which was the ATO. First corporate government role was with the ATO. I did a few years there, and I worked around both personal and business taxes. So I learned a bit there. That was more than 15 years ago now, so it's been a while. I think some of the rules have changed since I was there, so it's hard to keep across like everything that happens with federal taxes. From there, I worked with local council for a while in Sydney, so the Sydney Council, and then I took a role at Revenue New South Wales, and I initially started in the debt management area, so working more so with collections of overdue taxes. And then
what type of taxes are you collecting at that point, buddy?
So at that time, it was a lot of the state taxes. So it wasn't just land tax. I was working with payroll tax, duties. Every now and then, first home buyers don't quite meet the eligibility requirements and have to pay something back. So it was across the board. So all of the stuff that we manage in terms of taxes and grants. I haven't really had much experience in the fine space. That's another part of revenue where I don't really know much about, to be honest. But I just moved from collections into assessing, and then more into the technical space of policy and understanding all of that. And then, operations, compliance. I've sort of bounced around a bit, and these days working in stakeholder engagement. So very much around maintaining the relationships with our all of our stakeholders, communities, industries, key industry bodies, doing things like this podcast, just raising awareness and knowledge about land tax.
Fantastic. Very good, mate. Fly the flag for land tax.
Yeah.
Mate, you kind of glazed over it when you talked about, say, first home buyers and the what do you call it, debt collection around that. And everyone's going, hang on, mate, how does someone debt collect on a first home buyer grant? This is something that's, as I've done some research, and I'll even get a couple of my first home buyers that go, man, I didn't see this one coming again. Take us through what happens that someone then gets fined, or there's an issue around a first home owner grant.
So generally speaking, like when you go through and you put an application through for the first time owners, that's usually something that your conveyancer will do these days.
Yes.
The key scheme being the first home buyers assistance scheme, which is a exemption from stamp duty,
Great. Yeah.
right, up to a certain value. So what happens there is essentially there's a list of criteria. And I think the two that catch people out
Yeah.
more often than not is, one, there is a requirement to actually live in the property. Okay. So you can purchase it. And you can purchase it with an existing tenant or something in there.
Yeah.
But the rule is that within the first 12 months of owning it, you have to move in and stay there for at least 12 months.
Yes.
And where you fail to do that, you can find yourself in a situation where that exemption from stamp duty that you had is revoked, and you'll have to pay that back. So that's one situation. The other situation is people just not quite understanding when they're making the application that you can't actually get access to that exemption if your spouse has already had it. So some people will go, it's fine, we're not living together, but we will be after we buy this new place. And so people get caught out on those key things. I think they're two of the big issues where people don't quite understand what the obligation is to make sure that they, one, obviously get the exemption, but then keep it.
Yeah, cool. Yeah. Thanks very much. Are you at liberty just to kind of go a little bit deeper on these two? Is that possible? I know government, I'm like, I don't want to tread on any toes and make you uncomfortable, but just the question behind the question there is, you got to move in at the first available opportunity. I think it's the letter of the law. Yeah.
So it's essentially yes. So the way it works with the exemption is, as I said, like from date of acquisition, you have 12 months to move into the property.
Okay. Yeah.
Now, essentially, that's as it is. Like there's nothing really further around that. There's not really a lot of grey area around that. Okay, so, from the date of acquisition, you've got 12 months to move in. Failing to do so is just a failure on the eligibility requirements. So that is one of the criteria for eligibility.
So even if someone signed a lease and they're in that property, and then they come, I'll give you the example. So someone comes off lease and they got to give them like 90 days notice. These are all part of like your tenancy laws, and they don't move out. You're like, hang on, mate, I didn't get a chance to move in because the tenant stayed in longer than they expected to. Yep. Again, it might be a grey area.
It's not very grey, unfortunately. So the rules are quite strict.
Okay. Yep.
Look, there are situations where you can ask for some leniency, but there is quite a process to that. Okay. You really need to be able to demonstrate that things are outside of your control.
Yeah. But if it's above board, I mean, this is what we're saying, right?
Yeah.
People are skirting the edges, and they're going to get found out.
That's right. So it's best to try and comply to the best of your ability, because essentially investigations do take place to make sure that what you're saying is fact. But for the most part, failing to meet the requirement results in the exemption being removed.
Cool, thanks. Yeah, curious. I'm so curious because this is a completely different world to what I operate in. How do they check? Like, what's the mechanism to you to check?
Oh, look, I mean, there's so many mechanisms, right? That often it's just a case of a little bit of data matching, or just evidence that shows, hey, maybe like this property is not being used by this person. And it's not like Revenue won't come out and just slap you with a notice and say, hey, you need to pay us. Generally, what happens across all of our taxes, the first thing you'll get is a notice of investigation just saying, hey, we're looking into this, right? Now, that also happens at random too. We do random checks as well. When I say we, I don't exactly work in that area, so it is a different department that looks after that, but they do have a compliance strategy, and they follow up on customers. Either Dobbins happen to, right? Wow. Yeah. So there's a lot of different avenues that can see you get caught out.
A disgruntled ex.
It could be anything, right? So so there's a lot of ways that it can occur. As I said, best thing, just try and abide by what the requirements are, and save yourself a whole lot of hassle and potentially forking out to pay a liability that you're not prepared to pay. And that's the case often. Like for first-time buyers, they're often not sitting there with a nice bit of bank sitting there for a rainy day fund. And on an $800,000 property, so that's the threshold at the moment for the first-time buyers assistance scheme for a full exemption from duty. It's $800,000. Concessional up to $1 million, right? But at $800,000, you're talking an exemption of almost $31,000. So 12 months after buying your first property, and potentially if experiencing what it's like to have a loan and a debt to pay and a bit of added financial responsibility, you get served a $30,000 liability that you need to pay. Most first-time buyers don't have that kind of cash lying around, so it can end up costing you even more if you need to go into a payment arrangement and pay interest. So it kind of defeats the purpose. And I think having a clear intention around how you're going to use a property as a first-time buyer is really important. Like, have a plan before you make the purchase as to how you're going to use it, how long you're going to use it. Are you just going to meet the requirement and then rent it out? A lot of people these days are like, rent vesting is the way to go, right? So I'll rent vest and I'll just stay with mum and dad. And we get people who are like, I'll just leave it vacant for 12 months and then I'll just continue living with mum and dad's. Like, that.
Leave it vacant.
That's not okay.
I'll get forwarding, mail forwarding there, for example. But I'm like, well, here's how they check, because the utility bill is extremely low.
Exactly. Right.
Or the power use. So there's a very clear tell. For example, the other one is, they rent it out for cashies. Yeah. Yeah. It's like, man, for what? You win on one side. You can't claim the deductions because it's not claimed as an investment property.
That's right.
And you do the math. I mean, you're saying 31,000 on an 800K property. Geez, man, I should have got Nate. He's my human calculator here. 31K divided by 52 weeks.
It's a substantial amount.
It's a substantial amount, but you'd probably get more by paying the stamp duty and then renting the property out if you really had no intention to live in it.
Exactly.
Because the rental income would far exceed $31,000
in many
over
cases,
a 52-week period. So just do the right thing then.
Yeah.
Pay the stamp duty, rent the property out. You then get the tax deductibility and the depreciation, for example, potentially on that investment property. You get better borrowing capacity because I get to add the negative gearing add backs on that as well. And you're not looking over your shoulder going, I did the wrong thing. And now, as my mum says, you tell one lie to cover up another lie. And this is at some point, the lie is going to find you out.
Yeah, at some point, someone's going to find it out. And you're right. Especially when you mentioned utilities, like that's one of the key things that we'll ask for as evidence. So it's not just for the purposes of first-time buyers as well. Like, we do it with land tax as well. People who want to claim the principal place of residence exemption. Are you actually living there? So if you find yourself on the other side of an investigation for a principal place of residence exemption when you're not actually using the property as your home, like, there are certain types of documentation or supporting evidence that we'll ask for to substantiate actual use and occupation of the property as your home.
Yeah, cool. So, I feel like we jumped probably about 4 steps ahead. Everyone's going, hang on, mate, we haven't even talked about what land tax is.
Yeah, that's true.
Sorry if you're scratching your head going, what are these blokes talking about? So land tax in a nutshell?
Yeah. Look, land tax is in a nutshell. I'll talk specifically to New South Wales, but land tax in a nutshell it's a tax that you pay on the land value of property that you own. Now, every property in New South Wales has value. Has a land value. It's determined by the valuer general. It's called the unimproved land value. So it's not the same as the market value of a property, right?
Okay.
So you've got the unimproved land value, and it's not calculated on the value of a property at a time either. It's calculated on your portfolio. So we say the aggregation. So the aggregate land value of everything that you have an ownership interest in is what land tax is calculated on. So there is a threshold, a tax-free threshold, which most entities are entitled to, and we can dig into that a little bit more later, but most people are entitled to a tax-free threshold. Currently, that's $1,075,000. So if you own investment property or just property that's not your home or exempt for any other reason, if it's below that $1,075,000, you're not going to have to pay. Once you get to $1,075,000, then your land tax will kick in.
Okay.
And it's charged at 1.6% of the land. No, 1.6% of the land value above the threshold.
Yeah, cool.
Plus $100.
Yeah.
That rate applies right up to around the 6.5 million mark. So 6,571,000 at the moment. But up to that mark, you're paying 1.6%. After that, it increases to 2% for every dollar above that premium rate. So that's how it works in New South Wales. A lot of that is similar to how it works in other states. And I won't pretend to be an expert in every other state's land tax.
I mean, you've probably got a good vibe check on what the other states are doing. And
It's similar, right? So you'll go across states. There's aggregation is pretty common across most of the states. Northern Territory doesn't have land tax, but you'll find it in every other state and territory, right? So aggregation is pretty similar across most states. Principal place of residence exemption. So your home is exempt from land tax, regardless of the value. That's pretty common across most states as well. And having a progressive tax rate is also common amongst most jurisdictions.
Thanks.
The difference being the thresholds and the rates do change a little bit. And they're, the exemptions and concessions and stuff, they vary from state to state too. It's not like payroll tax. A lot of people go, if you know payroll tax in one state, you know it pretty well in other states. Payroll tax being another state tax that Revenue looks after, because there's harmonization between the different jurisdictions on a lot of elements of how the legislation works. That doesn't exist with land tax. So while there are similarities, there's a lot more, nuances between all the different states and how land tax operates in them.
Yeah.
So,
And it's become like a bit of a political handball. I remember probably about 12, 18 months ago where Queensland was talking about, land tax, aggregating that across other states. And everyone sat there scratching their head. I think there was a couple of investors going, I'm out of here. I was like, hang on. Yeah. They actually haven't implemented anything or enacted anything, but just the sheer whispers of some of that can cause a bit jitters in the market. I mean, probably the most topical one is Victoria around their land tax. Are you aware of?
Yeah, they significantly dropped their threshold. So now I think it's down to like 50,000 or something like that. So as soon as you
everyone's going, hang on, my land value at 50K, that's pretty much any block in the whole of Victoria.
But it's funny you say that, but only recently there's been stuff in the media around how the Melbourne property market's doing better than some of the other capital cities. So you go, well, I think it's important to remember that, you were talking about taxes before and the importance of what they are, to society, right? And how it all operates.
Yeah.
Taxes don't always make or break a market, nor do they make or break your investment strategy, right? It's just part and parcel of the property investment game.
Yeah. So you know what it is to me? It's like owning a car and complaining about CTP.
Yeah.
Or insurance. Or the price of petrol.
Yep.
I'm like, bro, you bought a car. Everything that comes on that journey now is par for course.
That's right.
Yeah?
Yep.
So the maintenance, the on-road costs, whatever it takes to keep that car running, insurances, that's why you bought. And people go and finance the car, so they end up paying with a personal loan as well. And you go and buy an investment property. It's like, I'm not going to buy in Victoria because of land tax. That's crazy. I don't understand that. If you're, again, to your point, the Melbourne market's on its way up, and that presents a growth opportunity for you to get in there and get some really good, strong capital growth. And potentially at some point, rents might correct and the yield might get better than what it is at the moment, which is kind of 4%. Then if it's ticking enough boxes, why are you then not getting into it because of tax? It doesn't make any sense to me. The amount of listeners that I reach out off the back of the podcast going, I'm a little bit uncertain about Victoria because of land tax. I was like, dude, if you're making money, you're paying tax. It's a very simple equation.
Yep. Yeah, 100%. And I think, all taxes, not just land taxes, all taxes operate like that, right? And, it's that thing, would you rather make $1 and pay a bit of tax? Or a lot of people are like, oh, negative gearing is the way to go. It's like, so what you're saying is I should lose some money.
Lose cash flow.
To make a little bit of tax back.
Correct. It's got a place. It's got a place. If someone's on some serious income and they need to minimize it, there's got to be tax efficient. They've got no other investments. I'm like, okay, it makes sense. It's a play. It's like running a certain play in a sports game. Like that play is going to be an advantage at that point in time.
That's right.
But you can't keep running like you take a football or like a T20 analogy for cricket. You can't smash every ball for six.
Yeah.
There's a time and a place to block or leave a ball or take a single, for example. But the negative gearing is like that is not the one size fits all approach for every investor. In fact, there's very few investors that I deal with that the sole focus is negative gearing. The goal is wealth creation through building a high performance property portfolio, which means you're buying growth assets, which means that equity releases to then go again and go again. Everything else that comes on the outside of that, should I buy through a trust? Should I buy through a self-managed super fund? CGT, land tax, GST, developments, everything that comes on the peripherals is, okay, this is everything we need to factor in, incorporate, but your hard fixed costs
Yeah.
are this, going eyes wide open, going, okay, no one told me about land tax. Well, man, no one told you about depreciation. No one told you about the insurances until you actually bought the property. Unlock a new level, and you're going to get to, it's like a video game. You unlock a new level, you're going to see these new demons appear.
Yep. And you know, you're 100% right there. Like there's a lot to it, right?
Yeah.
And you're right. Like negative gearing, it's not the be all and end all, but it can be an advantage, especially if you're just getting into the game, right? Like
Yeah.
you got to start somewhere.
Correct.
And you know, there are costs. There's costs everywhere you look, right? That's
the game.
Asset ownership is it comes with its costs,
Okay.
regardless of what you choose, right? But I think with property, like what a lot of people don't think about, and I think, you know, this comes back to that mentality of, oh, all these costs, right? All these taxes that I have to pay, all these costs and insurances and this and that. Like, yeah, man, that's reality. So one of the things that I often see people, or what people will come to me and ask sometimes, like in my role, I'll speak to a lot of people who are investors or industry professionals, or there's a dime a dozen out there of people, and everyone thinks that their strategy is the best, right? And they'll be like, you know, I bought this investment property. I bought it for $500,000. I owned it for 4 years. I sold it for 800, made 300 grand. And I'm like, great. Sounds great on paper, right? But what did you pay in insurances? How much interest did you pay on the loan? You know, what repairs and maintenance did you do? Did you have to pay land tax? How much capital gains are you going to pay on the sale, right? Like, and you start factoring all that in. You go, all right, not every strategy is going to suit every single person. I think that's something that people need to be careful about. We, being, you know, in a government organization, it's amazing how many people will come up to me at things like a property expo and be like, you know, I'm thinking about doing this and I'm thinking about doing that, and how does that work for taxes? And is it going to be the best move for me? And I'm like, I don't know your entire financial situation, nor do I know what your strategy or your long-term or your short-term goals are, right? And that's something that is individual, right? It's something that you determine about what you've got to work with, where do you want to get to, and you come up with whatever strategy suits your means, right? It's not necessarily the case that you have to follow whatever someone says is the best aggressive strategy to grow your wealth as soon as possible. Right. You know, that might work for some people and might not work for someone else. So it's really understanding, you know, what all of those costs and obligations are at the end of the day when you're deciding, where do I want to go with my investment strategy? You know, property in this country, at least, has shown in the past to be, historically, it's shown to be a good investment, right? Yeah. But yeah, you have to consider everything, approach it with your eyes wide open, get as much advice as you can, and don't look for that short, sharp advice that's just going to be like, oh yeah, you know, do this, do that. Like, spend time working with someone who's going to get to know you, your situation, what your goals are, and get good financial advice that actually, you know, is relevant to you and your situation, not just what you see plastered like someone says, this is my great strategy.
Man, I'm pretty much ready to hand over the reins of the Australian Property Investment Podcast to you, mate. It's that's exactly, you talk about singing off the same hymn sheet. That's exactly what we speak about, man. Like I'm amazed that it kind of rolls off your tongue, because I couldn't have said it better. Honestly, that type of sentiment is what sets people up to succeed, versus the ones that go, mate, I'm doing this for depreciation. For example, I've got to buy new, for example, depreciation. The ones that don't get growth in their portfolio, the ones that do it just effectively, you know, for tax minimization, because the only litmus test that people generally have of their accountant is reduce my tax. I don't want to pay tax. I am consistently blown away by the only measurement someone has on their accountant. They don't hear from their accountant all year. It's very much like their broker. They don't hear from their broker until it's time to, you know, refinance the loan so they get paid again. And then the ones that go, oh mate, the accountant saved me money. I was like, hey, why isn't your accountant trying to set you up to go and triple your portfolio, which then means you can retire on a really strong income, either passive income or you sell down your assets, for example, move into a retirement phase, or you then have choices. I think you and I were speaking before about work, balance, time. And then the beauty is you build a portfolio that gives you some time back out of not having to work like a fiend. That is what sits behind all this sort of noise, the tax, insurances, property maintenance, everything is just noise.
Yep.
You strip it all back. You can go and buy crypto. You can go and buy shares. You can go and buy gold. Pick up any AFR on the weekend. It'll tell you about all the different asset classes that are doing anything at any given time. Property, to your point, is something that's been tried, tested, and continues to kind of just, do some serious numbers. But you've got to understand what comes on the journey as being a property investor.
100%. Yep.
Perfect. So we go through land tax. You said I'm going to come back to the different scenarios. So you mentioned before the land tax threshold is there as an individual.
Yes.
Yep. So I'll give you the example. Aaron, so my wife Bernadette, Aaron and Bernadette own a property together. Now that investment property, we bought a freestanding home, for example, and in a corridor in Sydney. How is the land tax threshold calculated for us as a couple, as opposed to if I bought that property on my own?
That's a really good question, and this is one that trips up even accountants, right?
Correct.
Because in land tax in New South Wales, we have something called primary and secondary ownership.
Yep.
Or primary and secondary accounts. And what the whole purpose of that is to make sure that you can't get more than one threshold by purchasing under lots of different ownership structures. So if your situation, so let's say you and your wife buy your first investment property as an ownership structure, as an entity, a joint entity purchasing property, you'll get one threshold, okay, between you. So if you purchase your first property, let's say it's got a land value of $1 million is actually quite high, but let's say it's got a land value of $1 million, right?
Yeah.
It is below the threshold and you won't have to pay land tax. Let's then say you go together and buy another property, right? Another $1 million. Now you're at $2 million under this joint ownership. You're above the $1,075,000 threshold. You will pay land tax jointly, right? But in effect, what's happening, if you are only 50-50 owners, you're really only using 50% of your threshold, right?
Yeah.
And again, this comes back to whether you can finance and get a loan approved and all of that, but had you bought the same two properties individually, so you bought one for $1 million, she bought one for $1 million, you would each be 100% owners using 100% of your threshold.
Yep.
And you wouldn't be paying. Yeah. So look, some people look at that as a strategy to minimize their land tax. Can work for you, I guess. Depends on what ownerships you've got going on, because the next level to that is that, let's say for argument's sake, you've got, one property that you own with your wife, and then you come to me and you say, hey Vish, let's buy an investment property together. I go, let's do it, right? So then we go 50-50, we buy $1 million property, right? Still $1 million here, $1 million there, everything's fine. Yeah. We're below the threshold. But you're getting awfully close now between those two 50-50 ownerships to maximizing or using up all of your threshold entitlement. So let's say you then go and buy another investment property with one other person, right? And let's just say that's $1 million too.
Yeah.
Now, all of those joint ownership files or accounts, we call them, that's what we refer to as primary ownership, right? That is where the land is owned 100% under a certain structure. You'll get a tax-free threshold on all of those accounts, but then we'll come back and we'll be like, Aaron, mate, you've had half a threshold there, half a threshold there, half a threshold there. You've received too many thresholds. So then what will happen is you'll get your own individual land tax assessment as well.
Wow. Yeah.
And what happens there is we'll aggregate your portion of ownership between all those properties and we'll go, okay, this is how much land tax you have to pay. In this case, you haven't paid land tax in any of those other ownerships. So whatever it is that's above the threshold for you as an individual, you're going to pay land tax on that, right? If you had one of those, if we just switch up that whole example and just said one of the properties was at 1.5 million land value and you're paying some land tax there on that joint file. What we do then when we take a look at you as an individual, we go, okay, well, half of the land tax that was paid on that account as a 50% owner, we're going to give you a deduction from this individual bill that you have, okay, for half of that liability, and then you'll just pay whatever's left over if there's anything to pay. So that's how this primary secondary thing works, and that single individual ownership file where we aggregate your ownership interests across multiple structures, that's what we refer to as a secondary file. So it is more complex than it first appears on paper. You go, oh, there's a threshold, there's a premium threshold, easy, right? No. It can get a lot more complicated. And, you mentioned before around different types of structures, buying under trusts and companies, that complicates it further as well.
How does it complicate it, for example?
So certain types of entities are entitled to a threshold, and certain types aren't. Okay. So individuals are entitled to a tax-free threshold. Companies are entitled to a tax-free threshold. Where there's groups of companies, so if I go, I'm going to buy every single investment property that I own under a company. I'll go, I'll set up company A, I'll set up company B, company C. But if they're all related companies, meaning I'm the sole director, I'm the sole shareholder of all of them, we'll group them together. So that's not a way to go, I'm going to get 3 thresholds, right? If they're related corporations, we will group them together to make sure they only get 1 threshold between them, right? But saying, yes, okay, as an individual, I can get a threshold, a company can get a threshold, or a group of companies can get a threshold. Trusts is where it starts to get really complicated. So a complying super fund, so self-managed super fund, if you buy property in that, that's entitled to a threshold.
At the $1 million mark?
Yeah, well? same threshold across all of those. So there are some jurisdictions that have different thresholds for different things, or even different rates for different zoned properties. In New South Wales, that's not a thing. It's the same. But what does happen is when you purchase under a trust, we will take a look at that trust deed and understand exactly who the beneficiaries are. And that beneficial interest that you have as a beneficiary of a company. So let's say if it's a unit trust, for argument's sake, 1 class of units, right? 10 units, and I've got 5 of them, right? So if there's only 1 class of units, I've got present entitlement to income and capital, and I own 5 out of the 10 units. Well, then we can say with confidence that 50% of the land value that's owned in this trust belongs to me, right? And so that trust account will be taxed at that primary level, but at that secondary level where we take a look at, the aggregate value of my land holdings, because it's a fixed trust, I'm going to see that land value come onto my secondary file. So just setting up fixed trusts is not necessarily going to get you there. So you go, oh, fantastic, I'll set up a family trust, a discretionary trust instead. No threshold, right? So discretionary trusts do not get a threshold. So your typical family trust is a discretionary trust where the trustee has discretion to determine how they want to distribute any income and capital. And there's benefits to that, tax-wise, mostly at the federal level. But with land tax in New South Wales, that type of entity structure does not get a threshold at all.
So they pay land tax
from the first dollar of land value, you're paying 1.6%. So, and the reason for that is if you take a look at the way that these trusts are structured, who's the beneficiary? You can't, by any way, shape, or form, take a fixed portion of that land value and assign it to a person, because that discretion exists, right? There's another thing that kicks in there as well. We haven't talked about this, but there's surcharges for foreign owners. So in New South Wales, it's 5% of this. It's quite hefty. Okay. So if you're deemed a foreign person or a foreign owner, there's an additional annual charge of 5% on the land value, no threshold. Now, the problem with discretionary trusts is unless you explicitly, irrevocably exclude foreign persons from being beneficiaries, then the nature of the discretionary trust I'm talking about here, right? So unless you exclude foreign persons from being a potential beneficiary or a beneficiary of that trust, then by nature, it means that a foreign person could be a beneficiary of that trust. And therefore, you're also looking at surcharge impacts as well. And at 5% of the land value per annum, that's a lot. You can get around it by excluding foreign beneficiaries. But that's assuming you want to exclude foreign beneficiaries like that. Don't do that if you actually want to pay some distribution from that trust to someone who's a foreign person. But yeah, so there's a lot of complexities, right? Like it all sounds really straightforward at first, but the more you delve into it, different entity types, different structures, that's where land tax becomes one of those things that's just like, well, there's actually a bit more here than what meets the eye. Yeah.
Correct. if you've been listening, you're going, whoa.
Yeah.
You're not alone, because I mean, I do this daily. Even for me, there's quite a lot there to get your head around.
Yeah.
So if you're listening, like, I always advocate for complexity is the enemy, but this is the law. So there's a level of complexity that comes with, the letter of the law, tax. This is where it really helps to have a property savvy accountant. I find that's, some of our clients have even said, as their portfolio has grown, I had one client actually speak to me the other day that their accountant was like, I'm done. You guys are too big for me now.
Yep.
And I was like, that is such a good play from that accountant to go, there's some self-awareness to go, this is beyond my remit now. Whereas some accountants just go, yeah, we'll try it. And they, I've seen it, they give bad advice. They then get this land tax bill, and then we're trying to find ways to then effectively finance it potentially, or like you said, they go into a payment plan as well. And what that really does is it takes a lot of the energy or all of that steam out of their momentum.
Yep.
Because they're just like, the winds come out of their sails. Someone's got to be in their bonnet as to why didn't someone tell me? And then, it really halts that momentum. So if anything, it's worth asking the question. This is an accountant question, right? Without a doubt. Tax sits fair and square in their remit. So if you're looking about who in your team is responsible for this type of conversation, please go to your accountant. If you don't have a great property accountant, reach out to us. I'm more than happy to open a few doors where it's possible, depending on, I guess, self-employed, not self-employed, how complex your portfolio is and what you're ideally looking to do, so you can have someone that can grow with you as well. So, mate, I really appreciate that you opening that up. And when you start going to trusts, different types of trusts, for example, self-managed super fund, companies, individuals. I mean, you break it down, there's really only 4 or 5 buying entities that you can really go down. So when you simply break that down, you go, okay, that's palatable to understand, but it each has its own little nuances as well based on that entity. So coming out to your point here, the primary place of residence, no land tax is involved. It doesn't change based on if I buy an investment property that's residential or commercial. Is that?
So with the principal place of residence exemption, it's, it's a little obscure piece of legislation. Essentially, it says as long as the property is designed, constructed, or adapted for residential use. Okay. So what the zoning of the land is doesn't necessarily matter.
Cool.
But what we're looking for is that you're using the property and the whole of the property as your principal place of residence.
Okay.
And your actual use and occupation is what we're going off, not your intended use or occupation. There are some concessions if you're buying vacant land or doing renovations, and there's a whole list of principal place of residence concessions. We definitely don't have enough time today to go through all of them, right? But there's things for absence, there's things for, intention to build, there's things for 1-year exemptions where you're moving from one home to another. Correct. Like there's heaps there, right?
Yeah. Because I think there's a rule around a certain time to build. If it's vacant land, then you got to build within a certain time.
4 years, well. Okay. Yeah.
And then people go, man, the builders messed me around, or had false starts, for example. And I had one client get a bill and like, man, I genuinely just couldn't get my stuff in order in that time.
It can be extended, so you can apply to have it extended by an additional 2 years. Beautiful. In, again, circumstances beyond your control.
Yep.
So there are exceptional circumstances, and all that stuff is stipulated.
Cool.
There's, as I said, there's so many of these things hidden amongst, the legislation to wrap your head around.
Yeah.
Well, I think one thing that catches people out is like, you can only have one principal place of residence. Okay. So if you're living in a home that you own and you're buying vacant land so that you can build and move into, what your next place is, you're not going to get that concession, right? You've already got one property, and that's why I'll come back to that. Actual use and occupation trumps your intention. So if you've already got a place that you own and you use and you occupy as your home, that's your principal place of residence, right? Now, regardless of, what the value of that place is, it doesn't matter whether it's a shack, somewhere in regional New South Wales, or it doesn't matter whether it's on the waterfront, right? In Sydney Harbour. If you're using the entire residence as your principal place of residence, it's going to be exempt.
So what if some people in their owner occupied, they'll go travel, a couple of clients that traveled around the country, then they Airbnb their property out, for example. What happens there?
So what we're looking for essentially is that you've used, what we're looking for is that you've used and occupied the property for at least 6 months of the calendar year leading up to the taxing date. We haven't really talked about the taxing date. Land tax has a taxing date in New South Wales. It does in other jurisdictions as well. In just to be different, in New South Wales, it's based on the calendar year instead of the financial year. So whatever you own as at 31st of December at midnight, at that point in time, that is what will calculate your aggregated land value as, right? So at the end of every calendar year, whatever you owned at that point in time, that's what we're calculating on. The requirement is in the 6 months leading up to that taxing date that you've actually used and occupied the property as your home.
Okay.
Right. Now that's a little bit unfair, right? What if you only bought it in November? You can't have possibly lived there for 6 months, right? So we have discretion to say, hey, we can still give it to you, but we want to see that you're going to probably be there for at least a few months after the new year passes, right?
Yeah.
So we want to make sure you've been there for at least 6 months. So that's to get the exemption in the first place. Once you've got it, so once you've been there for at least 6 months, you can have a period of absence, right? That period of absence can be up to 6 years. And during that time, if you Airbnb your home or rent it out, you can still get a full exemption, provided that you haven't rented it out for more than, it's 182 days is what it says in the legislation, but that's basically 6 months, right? So if you haven't rented out for more than 6 months in a year, you can still get a full exemption. If you rent it out for more than 6 months in a year, then you lose that exemption.
Okay.
But it's one of those ones that, like I said, it operates for 6 years. So you can be like, okay, it's already my principal place of residence. I've been asked this question a few times by people who travel for work. So they'll get a contract to go overseas for a couple of years. And I'll be like, okay, we'll break it down year by year. So the first year, maybe you left in October. You lived in the property for the rest of the year, right? So already you're fine for that first tax year that first taxing day. The second year, you're away the whole year. You won't get it that year. The next year, you come back in March and then you resume occupation until the end of the year. So the next year, you'll be fine again, right? So you can slip in and out of that exemption, but the maximum period that it can run for is 6 years consecutive.
Cool.
Once you've resumed occupation for at least 6 months, it resets the clock.
Yeah, okay.
Yeah.
All right, cool. Thanks very much. What are the tips for rookies, or what do you kind of say? I mean, it's a rookie error. I see this all the time. For example, if someone's listening and go, hey, big takeaway from your perspective, what does that look like?
The biggest rookie error that I see is just not knowing about land tax,
Yeah,
right?
okay.
And because it differs from person to person. Like I said, you really need to understand when you're purchasing a property and deciding what structure you're going to purchase it under, and making those kinds of decisions up front is important. So one, I think getting poor advice and deciding to go with one structure because someone thinks it's a great idea, without necessarily delving into what your situation, what your goals are, and what your long-term plans for the property are. So, don't just follow advice that's given to you by someone who doesn't totally understand your situation.
Yeah, that's right.
I'd say that's rookie error number one.
Yeah.
Rookie error number two is just, like I said, just not knowing about land tax and getting caught off guard by it. So, classic situation, people purchasing a property. Someone told me it's a great idea to buy it under a family trust.
Yeah.
My home under a family trust, because I'm a business owner and I'm in a high risk, entity, and, it's going to protect the asset. And
if you can hear my eyes roll, dude, I've seen this, and I even question my own profession, like, have I missed something here? And I look at it, I was like, this is the most craziest bit of advice I've ever seen.
You see that kind of stuff happen sometimes, and people go, oh man, like I'm now paying land tax on my home.
Yeah.
And you know what? If there's a reason for it, cool. But if it just happens,
CGT.
Well, if it happens just because you didn't know, then that's a rookie error right there. And I think, getting educated, spending some time educating yourself, not just always just relying on what you're told. Even if you've got a really good advisor, spend a little bit of time like doing research, hop on the websites, man. It's really easy to find information from the ATO,
Vishal, you
Revenue,
say that,
and
you
everywhere
say
else.
that, bro, but you got to understand, like these transactions are happening at speed.
Oh yeah.
And I think this is where, and I told this to my team yesterday, prior planning leads to piss poor performance, right? I said that to them. Pardon the French on that. But when you're going at speed, you don't have time to slow down and dot your I's, cross your T's. I'll give you an example. So when people are looking at properties and aren't pre-approved, that's in my mind rookie error number one. When you don't have an idea about the buying entity and you're moving at breakneck speed, crazy. When you're looking at properties, you don't have a conveyancer lined up, crazy. These are just things when we talk about the foundations and the building blocks of just getting things right. Doesn't matter if you're buying your own home, doesn't matter if you're buying an investment property, for example. When you're trying to move at speed, and right now in this market is going like at COVID speed.
Yep.
It's bonkers at the moment. And so I see it all the time. People are just going, man, I've got to move fast. I've got to go quick. Yep, we're going through a trust, set up the bang, and they're going at like lightning breakneck speed. I'm like, this is going to catch up with you at some point because you haven't had the time to think through it. So there's tempering this energy going, do your due diligence, get it correct, but keep momentum going, as opposed to now I've got to think through every single combination. Then it's over, analysis paralysis. So there's got to be somewhere where you can kind of meet in the middle to go, this is a sweet spot. If you're listening and you go, right, I want to get into the market for 2025 and where, this will be done for September, there's still a few months left. But it means you need to pull your finger out if your goal was to buy a property this year, and then think through, okay, what's my stamp duty? What are the other taxes, costs, buyer's agents fees, onboarding costs? And then what do I have land tax considerations in place here as well?
Yep. Yeah, 100%. Like it's, planning, very important. Spend the time. It's that thing of like, read before you sign the dotted line, right? And you don't need to spend, analysis paralysis.
You know what I reckon, like with digital signature, like digital, these contracts, no one's even looking at them.
Yep.
Bro, I'm telling you, I run it through GPT now sometimes when I'm like signing contracts. I'm like, tell me what I need to know. It's crazy, some of the stuff that I'm like, I would have just signed this willy-nilly. Now I've got a bit of a summary on like, okay, too long, didn't read it, but this gives me spits out key things to think about.
Yeah.
Yeah.
Yeah, 100%. And, you said analysis paralysis. And I think that's really important as well. Like don't get too wound up in it. It's good to be educated and sort of know a bit about what you're getting yourself into, but there are industry professionals out there who are experts in these things. I said the key there is making sure that you're communicating with them and they understand what your goals are and what your financial situation is, so they can give you the best advice, right, to make the right decisions. So.
Man, I love it. I know I can hear your mind just this stuff just comes freely. Obviously, you've got years under your belt of experience. That's where I love what we can do here for a lot of our listeners, which is someone that takes years of this knowledge and expertise, packages it up very nicely for someone to go, okay, you plant the seed in terms of knowledge power. But may I want to say thank you very much for coming in.
Thank you.
I mean, we were talking before even about stamp duty and how much that changed. And a lot of our New South Wales first-home buyers years ago when we talked, they brought out the up to 1.5 mil.
Yep. It
was the annual stamp duty. Like there was a lot of talk around that, for example. It's one of these, again, I won't say political handball, but it pops up and it's like, okay, this is a really good idea. Rolled it out, shelved less than 12 months later, I think. Yeah. And there's probably a lot of internal stuff that has to
we still manage
mobilize to then get it rolled out, right?
We still manage that because, so what you're talking about there was the property tax scheme, right?
Yes.
And at the time that it was available, you could opt in and instead of paying
the upfront stamp duty,
you can pay an annual property tax instead.
Yeah.
And I think there's about roughly 7,000 people who
it's not a lot
opted
though,
in.
is it? Is that?
It wasn't there for a long time as well. So you got to remember that. Like I said, less than a year.
That's a lot of administration for 7,000 people though.
But now these people are in that property tax regime and they're still in it, right? So the way that thing worked was as long as you own the property, you'll continue to pay that annual property tax. So the product still needs to be managed because there is ongoing administration and assessments that work with that. But you're right, but it just goes to show how quickly the game can change too. With first-time buyer schemes, generally speaking, the closer you get to an election, the more activity you'll start to see around some of those different schemes, and you'll see movement in that space.
But it's not only the lead up to the election; it's like the lead up. It's to come out of the election. I mean, look at Albanese, and you go, "Man, that was shelved for 1 January, and it's brought forward to October." Mate, it's insane what it has done to the market.
Yeah, so that's obviously that's a federal scheme, so we don't really administer it. But I know what you're talking about. And you can already see now. If
You can see
you've been watching sort of the media and stuff over the last couple of weeks, you can see the markets picking up. Interest rate drops and this new scheme. And I think these days you've got, it's not necessarily just investment or aggressive investment strategies where you've got a lot of people who are looking to invest in those first-time buyer markets as well. But that's the thing, right? You do have quite a few people these days that are really looking at those first-time buyer markets for investment properties, right?
Well, it's a good entry point, right?
It's a good entry point.
So many first-time buyers will go toe-to-toe with an investor.
That's right. And then you have a change in
these. The investor will win because, maybe deeper pockets or the ability to, move faster than a first-time buyer is dragging their feet.
Yeah. 100%. And then you've got the first-time buyer schemes that are sort of encouraging people to look in that same price range. And
correct.
That creates a lot of competition, and it makes the market move very quickly.
Correct.
But that's evident right now, as we speak. So
I agree, man. It's an exciting space. Yeah,
it's really, you could spend so much time looking at what happens in the property markets across Australia and never get bored if you're into that kind of stuff. Maybe I'm a nerd, who knows? But it is very interesting.
Yeah, I mean, you even mentioned before that you've gone out to some of the property seminars. They have those big expos, for example. Yep. Mate, you'd hear it all. Like, I hear some crazy stuff. I'm like, you get these Reddit groups, you get Facebook groups. And they're always cooking up these strategies about how to like dodge tax, not pay tax, none of this, and like cut corners. Mate, I think there's a lot to be said around, one, playing with a very straight bat. Yeah. Two, I mean, yes, there are ways for grey areas. There's creative lending, whatever you want to call it. Yes, there are ways to bolster and grow your portfolio, but you don't be doing that looking over your shoulder. Yeah. And if it sounds too good to be true, mate, it probably is not. They are. Even in business, I'm like, sometimes the shortcut is the long way.
Yeah.
Yeah.
100%.
The shortcut's not the shortcut because you can get found out. Portfolios go up in flames. I've seen businesses go up in flames because they try to take shortcuts, for example. There is no shortcut. And if someone tries to tell you, I don't know, unless they've done it themselves and like they're very clearly made it, then I'd be questioning if those shortcuts are actually the shiny object or it's actually legit as well. Yeah, man. I want to say thank you very much. I appreciate it.
Thank you.
It's tax. It's you've made it sound very, very interesting. Land tax. You've pricked my interest, mate. So I want to say thank you very much. And to everyone, I'll just wrap up where I started and where I finish off. Paying tax is a success fee. And like I said, whether it's in your business, whether it's in your property portfolio, whether it's capital gains once you've exited certain assets as well, just understand, yes, we are all trying to be tax efficient, tax effective, maybe minimize tax where possible. Absolutely. But sometimes it gets to a point where you just have to pay tax, cop on the chin and just go, yeah, mate, I've made more money. The pie's got bigger for us or my family. Cop it and move on.
Agreed. 100% agreed. 100% agreed.
Love it. Hey guys, if you know that someone's unsure about land tax or you always want to share this episode, we love it when people just kind of flick it off to a partner, friend, fellow investor as well. That's a wrap for another episode of the Australian Property Investment Podcast. Thanks for tuning in.